The Reserve Bank of New Zealand, the Bank of Korea have both lifted their interest rates by 0.5%. So will the RBA likely follow? And what's in store in the coming months with interest rates and where we're heading? Well, let's dive in and have a look into it, deep dive, look at where the similarities are with the world and what we're seeing in Australia as we're all sort of trying to tame inflation. So let's start off on the top, having a look at what actually recently happened. So as we can see, central banks in New Zealand and Korea have both pushed ahead with further supersized increases in interest rates as they attempt to tame inflation. Now, both have been at the forefront of the global central banks' move to quell inflation as they lift interest rates from pandemic lows that we saw both sort of central banks increase rates in the second half of 2021. Many months ahead of what other central banks have done. So Australia being one in particular where we only started increasing our cash rate from May this year. And we know inflation is a real issue that the banks are grappling, particularly off the back of some very challenging times. Now, the Reserve Bank of New Zealand, they moved from 2% to 2.5% on Wednesday, whilst Korea increased their cash rate from would have been in the 1.75% to 2.25% previously. So we've seen an increase for both banks. At the moment, the Australian cash rate is at 1.35%. So it might be something that we can see coming through, another sort of 1% increase. Now, the Reserve Bank has actually, of New Zealand, the Reserve Bank of New Zealand has increased their cash rate officially for the third month in a row by 0.5%, which was almost expected by all analysts. Now, with regard to what we're sort of seeing, there is calls. A lot of economists are saying that there's a 50-50 chance that Australia will follow suit, where we might actually see another rate rise of 0.5% in August, which will bring our official cash rate to 1.85%. We also saw some information come out with consumer confidence being at sort of recessionary levels of low. So consumer confidence is certainly at a very low point at the moment. And I guess that's off the back of surging inflation, and the jump in interest rates is having a bit of a weight on households as we see that confidence slump. Now, spending levels are still elevated, as we can see here in this graph. And we can also see the confidence levels, they're getting pretty close to where we saw at the pandemic levels. Now, the Commonwealth Bank's economist has actually sort of predicted that the official cash rate will get to 2.1% by the end of the year, which will lead to slower economic growth and a forecast of a 15% drop from peak to trough in house prices by the end of next year. So they're sort of saying with the increased cash rate, the lower confidence in the market, we might see that reflect on property prices across the globe. So across the country, I should say. Now, one of the things they say that many economists are coming of the view that with this string of aggressive rate rises, many countries are nearing the end of what will be, the peak in interest rates. There's an economist here, Marcel. He's actually expecting that there may be another 0.5% increase in New Zealand, which would bring their official cash rate to 3%, and has a view that with the housing downturn, it's going to weigh heavily on residential investment and constrain household spending, which will likely stop the banks or the central banks from hiking interest rates any further than the 3.5% that they're predicted for New Zealand. Now, in Australia, our cash rate is predicted anywhere from what we saw there, from the 2.3% is what CommBank, or 2.1% is what CommBank's saying. We've seen predictions from 2.1 to that 3.5% mark. And Marcel goes on to talk about that with the recent drop in commodities, and I guess it's going to mean that there's going to be a favorable effect on cost of fuel and energy prices that should slow the peak or slow down inflation. And also he talks about the slowdown of the economy and everything like that. Now, I guess, how did we get here, and what does it all sort of mean for you as a home buyer or someone that's looking to get in the market? Well, we saw when the pandemic hit, there was a lot of central banks, so the American Fed actually said, forget the bazooka, we're going to go nuclear. And they're literally going to throw everything and every effort to buffer the free fall of the world's largest economic downtrend and prevent the world from going into a global credit crunch. So this is what we saw in 2020, a huge amount of quantitative easing, where known as QE, where effectively the central banks were buying up, as they say in here, unlimited assets to support markets. So they were buying up assets through use of bonds and whatnot. What we saw in May this year, the Reserve Bank actually said they're reversing course. They're no longer doing quantitative easing. They're going to move to a more quantitative tightening. So what does that mean? Well, what it meant was, as we can see here, when the governments around the world started quantitative easing, we can see the amount of bonds that were purchased went through the roof, and they pretty much all did it at the same time. And this gives us an idea, because if we see New Zealand here, they did pretty much quantitative easing at the same time as Australia, as where we might be going with the cash rate in Australia. So we can see the central banks bought up a heap of bonds at that stage to prevent a free fall in the markets. What that meant was, for the RBA, a huge amount of 3-year bonds were purchased on their balance sheet, and we can see when they're maturing, mostly coming up in 2023 onwards. Now, one of the main ones was the TFF, which is effectively the commercial banks could borrow money from the Reserve Bank at relatively cheap levels and lend that out to continue to keep businesses and things moving in the economy. We can see a lot of those bonds are actually coming up in 2023 and then in 2024. And as we can see here in the conclusion, the Reserve Bank said in May that they removed their extraordinary policies for stimulus in the market that they put through during the pandemic, and now they're moving towards more of a tightening effect. So they say to call it quantitative tightening, which allows bond holdings to mature in a steady and predictable way over time. Now, they talked about the fact that bond purchases, their quantitative easing program, which is effectively bond purchasing program that was adopted in late 2020 to provide additional support to the Australian economy at the same time with cash rate being reduced, was obviously going to stop. And this helped, by the way, the fact that it reduced the yields that was going to potentially further curve and contribute to lower Australian dollar than it otherwise was. So they took steps to remove this considerable monetary policy. So the stimulus program that they're actually removing, and now they're looking to move towards more of a quantitative tightening, where it's increasing the cash rate, which they took as a tried and tested measure, and will end their TFF program, which we talked about there, as we can see a bunch of TFFs coming up for maturity through the government program. So that's straight off the Reserve Bank's website. But what was interesting was John Adams actually talked about the fact that he believed this quantitative tightening is a fake program. And you can check out his article online for the fact that he said that the quantitative easing program that we saw was one of the largest and most extraordinary monetary policies in Australian history. And for policymakers, they're now faced with an impossible task of trying to rein in inflation to prevent financial instability and also the record Australian debt bubble from collapsing. So he also goes on to talk about the fact that the RBA ending the QE program has become probably a difficult task of raising interest rates at the same time as announcing the quantitative tightening program, whilst he believes that the 2020 tightening program is insufficient. It'll start to be of a material size in 2023 and 2024. And we saw some of this talks in the media, like Commonwealth Bank economists actually said in the second half of 2023, they can see a reversing of course where the cash rate might be elevated to the point where they have to start to reverse course because the economy could be in a bit of a trouble. And that's particularly if we get into a recession. He also talks about the Australian commercial banks having to pay back those QFFs that we talked about. TFF, sorry, not QFF, the TFF, so we can see. He talks about the fact that the commercial banks having to pay these back, the capital that was borrowed under the program in 2023 and 2024, and how that's going to put the pressure on the economy there. So he talks about the effect of the quantitative tightening coupled with raising interest rates and will have a significant impact on interest rates and the overall economy in Australia. So he also goes on there saying that because we're heavily indebted, that it's likely going to find that if it's unchecked, we might result in a deflationary spiral that could threaten the stability and solvency of Australian commercial banks. So he said, given that that's the case, he can't see policymakers willing to accept this outcome. So his prediction is that there'll be, at some point in time, a pause of the monetary contractionary, so the tightening, and effectively, ultimately, a reversal of monetary easing and potentially back to what we saw with the quantitative easing. This also, he calls the quantitative tightening program both fake and disingenuous, which also kind of brings us back to what we're seeing in the sense that we might be getting to near peaks in Australia, maybe by the end of next year, more likely to be early next year is what they're saying, and even a potential reversing, of course. So it'll be interesting to see what happens. I guess no one's got the crystal ball. We saw with COVID a bunch of experts predicting that the market was going to crash. That didn't happen. So it's interesting to see what the thoughts are out there, what people are saying, and how it might impact homeowners out there. But as always, guys, here at Hunter Galloway, we're mortgage brokers. We help people Australia-wide. We're based in Brisbane, but we help if you're based in Perth, Sydney, Melbourne, Adelaide, looking to buy an investment property, buy your first home, you're wanting to have a chat and review your mortgage, hit us up at huntergalloway.com.au or call us on 1300 088 065, and we'll see you next time.